Kirk, you there?
Yeah, I'm here, Jason.
Did you like the music?
Loved it.
All
Got me
right,
all
all right.
excited.
I know. I thought it'd blow out your ears a little bit. I saw. All right, sorry for that. So it's Kirk Chrisholm on Twitter at the same name, Kirk Chrisholm. It's or no, I said it wrong. Kirk Chisholm.
There you go.
Yes. Okay. I added an R in your last name. I bought an R. Isn't that nice? So he's a wealth manager, self-directed IRA expert. Website is Innovative Wealth, Alternative Investments. So talking about IRAs, low risk options, things we can do. You also host a Money Tree podcast, which is popular. And, like this day and age, how are you directing people, I guess, in their like 20s they have a lot of capital at risk that's risky capital? How would you say for an IRA what they should look to do and build more of a long-term portfolio?
Yeah, I think it's a great question. Depending on how old people are, they're going to have different interests, in the stage of their life that they're in. There's one thing that we always talk about when we're talking to clients is Peter Lynch had an adage of invest in what you know. And I think that's really important. We're agnostic when it comes to investments. We specialize in alternative investments held in retirement accounts, which is kind of a weird thing for most people that never heard of that. But what I find is some of the best investments we've seen come from the investors themselves. And to give you an example, what I mean, some people want to invest in rental property or real estate, or private company stock, or cryptocurrencies, tax liens, airspace rights. I mean, we've seen some really interesting investments from investors that, we're seeing returns that are probably things that you wouldn't believe, but because they're not publicly traded, they tend to be a little bit, let's just say there's some benefits to it because of the illiquidity, and that you can find things at a better price than you would normally. So you can get some better returns if you know what you're doing. So we really like it when people invest in what they know.
Got it. So, well, I guess what my question is, you've been a money manager for a while, financial advisor?
Yeah, since 1999. Great time to start.
That was a great
December.
time to start. Yeah, no. Oh, wow.
Specifically December.
Well, like no matter how good you're in the market, like no one can have a crystal ball. I keep in my wallet my stock certificate where I sold Amazon at $10 a share. So I did. I know I did. And then it took me several years to go buy it back, but I did buy it back eventually. I think it was like 340. My question to you is, are you seeing what you saw back in 99, 2000, the past, say, year? That's what I would like to first ask.
That's a great question. So I've been doing this since the 99. I've seen a few bear markets. I've actually, we do a lot of research on this. And one of the things that I've really noticed, especially in the last few weeks, is this feels a lot like 99 and 07. It feels a lot like it. And by that, I mean, not necessarily the market movements or, how things are operating, which are a little bit nutty. What I mean is the people, the investor sentiment. So I'm getting calls from people who, let's just say hypothetically, they invest in like cryptocurrency, and then it goes down 20%, and then they sell it, and then they call me back the next day, and it's up again. They're like, I can do this. This is easy. And I remember hearing conversations like that in the 90s and in 07 with real estate, how people thought they were invincible. They're saying, I don't need an advisor. I can do this myself. Right. You can. When everything goes up, it's really easy to make money. But I think what's important to understand is that investor sentiment really, in many ways, dictates how the markets move. And right now, what we're seeing is this extreme bullishness. Investors are getting trained that, last year being a perfect example, the markets dropped in more than 30%, or at least the S&P did, and it went back up and ended up like 15%. I mean, what kind of world do we live in where that is a rational thing, where the whole global economy shuts down and yet the market ends up double-digit returns? That's crazy. So, you could argue whether that makes sense or not, but the reality is that that happened, and it leads people to believe that nothing can go wrong. If, like, imagine a situation that's worse than COVID, where the global economy is shut down, people are stuck in their houses, and the market ends up for the year. It's hard to imagine, right? So, when I look at things like that, I say, all right, what's rational, what isn't? We're seeing signs that the market is, it's probably on its last legs. This is how it feels in 99 and in 07. This is exactly how it feels, where people feel invincible. They feel like it's easy. I start to get comments from clients that are really pointing in the direction of, I don't know where the end is, but we're close to it.
Got it. Okay. No, then it's interesting because you have a lot of clients, so it's a different perspective to hear from you. Now, a lot of people talk about trading in their IRA or trading their retirement accounts, and then they have their retirement accounts, and then they have their active trading accounts. What do you suggest? Is that the way to do it? Like, should you make more of your trades in the IRA accounts? So you don't get so it's tax free. How should you go about that?
Yeah, I mean, if you have to split your investments between taxable and IRAs, if you're getting income, so if you're, getting any sort of bonds, we do some private investments that produce income. Stuff like that's probably better in your IRA because it's sheltered and you're not paying income taxes on that. Capital gains, especially long term, is more preferable in your taxable account. But if you're doing a lot of trading, your IRA is probably going to be better. The way I kind of think about it is, and there's this kind of misconception that Roth IRAs are better than traditional IRAs because they're tax-free. In actuality, they're identical. If you really kind of run the numbers, which I don't think too many people have. But if you have your best performing stuff, now, of course, you don't know that it's going to produce the best. If you did, you'd probably live on an island by yourself. You'd be able to predict the future. But if you, let's say, we're investing in cryptocurrencies, that you would either get a very binary outcome, either it's going to be a lot higher or a lot lower, then that might be a good place to put it, would be like a Roth IRA. But your traditional and Roth IRAs are pretty much identical, assuming all else is equal. The outcome is going to be the same. And if you don't believe me, run the numbers.
Okay.
What it really comes down to is your tax rate going in and your tax rate coming out.
Okay.
Those are the only determinants that you can figure out, because otherwise, I mean, you can't predict the best investments. You can't predict what tax rates are going to be in the future. Everybody says they're going to be up, but then the last 4 years they were down, even though people thought they would continue going up. So you really can't know the future. You can only know what your tax rates are in the grand scheme of things. Are you on the low end or the high end, coming in and going out? So that's how I would look at it.
Okay, so we're with Kirk Chisholm, self-directed IRA advisor, wealth manager. So a question I'm going to ask for myself. So I'm 42 years old. I have, through Benzinga, we have like I guess an IRA, or what do you call it, that match it? Is that what it is? Okay.
401k?
401k, sorry, 401k. I have an IRA that I set up many years ago. It was a Roth, but it was set up like 15 years ago. I have a 401k. Am I supposed to be doing like something else, like set up a new IRA all the time, or is there other income limits with an IRA? I know I can't do a Roth, but is there? I don't know. Like, that's what I was curious about.
Yeah, so it depends on your income. I'm not going to make you disclose that in the show, but it depends on your income whether you can contribute to an outside retirement account. If you have a 401k at work, then you should try to maximize the 401k at work. Most 401ks at work will have a match, which means you're getting free money. So I'll give you an example. Let's say a company is matching you dollar for dollar up to 3%. If you put in 3%, they put in 3%, right? Well, what's nice about that is you just doubled your money. You could have your money in cash. You just made 100% return on your money. There is no better investment than that I've found, that you're getting those kind of returns. So I think from that perspective, your 401k is going to be a better option, especially for employees.
Okay.
Now, generally speaking, if you're able to max out your 401k, then you can look for other ways to, and as an employee, there are fewer ways. As if you run your own business, there's actually a lot more ways you can do it. The rich dad, poor dad philosophy of, the 4 quadrants of being a business owner, there's a lot of merit to that. in that there's a lot of tax advantages and ways you can put away extra money. But as an employee, the 401k is the way you'll probably be able to put away the most amount of money per year.
Got it. And are there other things that, like, as an employee, tax incentives that we don't necessarily think about when investing, or tax?
Yeah, it's really hard as an employee. You pretty much have your 401k as your best tax benefit. Sometimes companies will have other benefits along, and I can't speak to every company, but some of them will have non-qualified plans. Some of them will have executive comp plans. It depends on what they have, but most companies, 90+% of them are just going to have the 401k plus maybe some other benefits like stock options. But that's really the best thing. As an employee, as a W-2 employee, there's very little you can do to shelter income outside of the 401k.
And where are you from?
Where do I live?
Yeah, what state?
Yeah, Boston, Massachusetts.
Okay, 'cause I just didn't know if you're like in a no state income tax like Florida or other places that a lot of people are moving to. I mean, Puerto Rico, I hear about.
Yep.
Because taxes are expensive.
A lot of people are moving to Puerto Rico. Great tax benefits there. I'm not sure I'd want to live there, but I think the tax benefits are great because, as far as I know, there's no federal taxes you pay, and you're in the U.S., so you don't need a different passport.
Kirk, I'm such a talker, man. A year ago, I worked on it, and then I didn't follow through. And I would have, you understand. But there's more stipulations to it too. You have to. It's for a stock trader or a media type business like us. We could do it. We have a couple of our competitors that do it, and that's where it can be powerful. But we'll go back to what this is about. So, are you actively trading too? Are you finding opportunities, or are you more of an investor that's looking for like long-term dividend growth investments?
Yeah, actually, we're very different probably than almost any other advisor I've met. We have a different philosophy than most. I mean, I've been around the industry for a while. I majored in economics in college. I know all the theories. And most people have this buy and hold mentality, right? Or I call it buy and forget. And that worked in the 70s, 80s, 90s, where you could buy and hold. It works in long bull markets. The problem is we're in kind of a different era where, if you look at 2000 to 2013, the market basically went a lot of places, but it basically, was neutral. If you took that 13-year period, at the end, you would have ended up with the same amount of money as you started with. So what you lost was time. And that's a really important thing for people to understand. If you're investing now, we could argue where the market's going to go. Nobody knows. It could go up. It could go up a lot higher than this, or this could be the peak. We have no idea. But I would argue that we're closer to the top than we are the bottom. So, that being the case, if you look at 2000, the market took 13 years to get back to where it started. What if that happened now? Do you want to waste 13 years just buying and holding and hoping that the market comes back? So we have a very different philosophy. We look at the markets as there's kind of this thing we say is most people look at investing as outcome-based thinking. Outcome-based thinking is the market's going to go up today. It's going to go down. Apple's going to do this. The S&P is going to do that. Who's going to get elected? What's the Fed going to do? That's outcome-based thinking. The problem with outcome-based thinking is it relies on your predictive ability to predict the future. Now, I don't know about you, but I can't tell the future. I wish I did. And if I did, I probably wouldn't disclose that here. But none of us in this industry can tell the future, but we all pretend like we can. And that's kind of the way that we're wired, is to be able to predict the future. So picking stocks, picking mutual funds, ETFs, it's based on your ability to predict the future. We look at what we call outcome-based thinking. Now, outcome-based thinking is knowing that we can't predict the future, but figuring out how we can invest accordingly. So, for example, I didn't know who was going to win the presidential election. Could have been Trump, could have been Biden, or could have been undecided, right? It was a little bit of undecided, but it was, Biden ended up winning. But we didn't know, but we didn't need to know. Because the way I looked at it is no matter which person won or if it was undecided, we have an outcome. We have a strategy based on that outcome. And so that, if the market tanked, we'd have been fine. So as an example, last year, market went down 30 some odd percent, went down rather quickly. Most people were caught, flat-footed on it. And, we were down a few percentage points. We didn't know that was going to happen, but we were prepared for it. No, I mean, some people could claim they predicted it, but no one could really predict something like that where the whole world shuts down. But we were prepared for it. We know the market's going to end, the bull market's going to end at some point. We don't know when, but we want to make money when the market goes up and not lose when it goes down. That's really kind of our philosophy in investing. And it all centers around risk management, which we can talk about, but that's risk management is of primary importance when you're investing. And I think most people look at, what I find is most people look at performance first, and they say, oh, what did I do this year? What was the performance? They never look at how much they lost when it went down, or they're always looking at, like, how can I get that brass ring? How can I get up there and get that great return? And it's meaningless if you lose half your stuff. So you don't need to outperform the index every year. As long as you don't lose big when the markets go down, that will allow you to outperform more than any other strategy.
Okay, so couple quick questions. This one was coming though. Do you like crypto?
Yes, I love crypto, for probably different reasons than many other people like it. I like crypto because it accentuates an investment philosophy that we have, in that it's so extreme. So if I think about cryptocurrency, right? We invested in crypto in 2017. We invested earlier this year. Imagine it this way. Say you go to the casino, right? Let's assume you're playing, I don't know, blackjack, right? Your odds are close to 50-50. So let's say it
doesn't feel like that.
It may not be, but that's what they tell us. But anyway, so let's say it's 50-50. You're going to bet on something, right? Heads and tails. A good example. You're flipping a coin, heads and tails. You have a 50-50 chance of winning and losing. Now, let's say if you win, you're going to make 10 times your money. If you lose, you're going to make $10. Let's say if you lose, you're going to lose $1. How much money would you put into that game? Now, for me, I would put in every dollar I owned plus every dollar that you owned and everybody else I could talk to, right? Those odds are heavily in my favor that if I'm flipping a coin and I win, I'm going to win 10 times my money. Now, I look at cryptocurrencies much in the same way. You have to go in looking at it as if you could lose all of your money if you invested in cryptocurrency. That has to be an assumption that you make going in. And if you're comfortable with that assumption, then you really should be okay investing in cryptocurrency. So my thesis was, all right, I invest, let's say, and don't take this as advice, but let's say as an example, let's say I put in like 5% of my portfolio into cryptocurrency. I know that if cryptocurrency goes bad, I could lose 5% of my portfolio. That's my worst case scenario. But now let's say at the time, my thesis in 17 was it could go up 20 times. Now I look back and say that was silly. It could have gone up much more than that. But let's say I could have made 20 times my money. That to me makes sense. Okay, I can make 20 times or I could lose one, and the odds are, let's say 50-50 as an example. I'm okay losing 5% for the chance that I could make, 100%, right, on that 5. To me, that makes sense. So it's not just outcome-based thinking. I'm looking at probabilities. I'm looking at risk management. And there's another piece of this too, which I think a lot of people don't talk about because, it's hard to do. So in 2017, when we invested in crypto, when it went up 100%, we sold half of it. So now I have no risk in that investment. I sold half of it. I took my principal off the table. I'm playing with the house's money. If it goes to infinity, I make lots of money. If it goes to zero, I don't lose anything. So it's not just about what you invest in, it's how you manage the risk around that investment. So I love cryptocurrency. It is the best extreme example of this. Wall Street calls it asymmetric risk trade. So asymmetric being more on the upside and less on the downside. And that is a perfect example of that.
No, it's a different way to look at it. I loved hearing that, and the chat loved hearing it. All right, I'm gonna ask one like our Roth IRA question. They've been asking me a bunch, and I'm just gonna ask one. Let's go. I had to scroll up. The guy. Okay. But you already answered the pre-tax thing with the Roth versus the IRA. So let me go to one that I think is one that you haven't talked about, because they definitely filled you up here, guy. But the Money Tree podcast. So you can listen to you at the Money Tree podcast. And what's your company name?
Yeah, so Innovative Advisor Group is my company name. The website is innovativewealth.com, and the podcast is Money Tree Investing Podcast. It's one of the oldest investing podcasts out there. It's been around for 6.5 years.
Wow.
So,
all right. Yeah. Here's one. Do you have to pay Social Security tax when you draw from a traditional IRA?
Depends. I mean, you have to pay. You don't. You pay when you pull money from an IRA. You're paying taxes as if it's income because it's delayed income. So, in many ways, it depends. I mean, some of these questions is hard to do in a bubble.
That's what I knew. Because
you need to know more information.
So, someone answered then exactly. Okay. And have you heard of Benzinga before we reached out to you?
Yeah. Oh, yeah. I love you guys. You guys have known about you guys for a long time.
We have this cool thing, Benzinga Pro. If you're ever looking like for the real-time news side of it, like just where it's no ads and you could put what your portfolios. You guys probably have I don't know if you already have a system you guys use, but we can send it to you. It's cool. Just it's a good way to keep the real. It's like a Bloomberg terminal, but different. That's what I would say.
That's awesome.
Yeah, about 30 people on that thing. So, Money Tree podcast. Check out Kirk there. Honestly, like it's when the market goes straight up, it's really easy to day trade and make a lot of money, but that's not a long-term way to preserve and grow money. It's just not. So, I use someone like it's always smart to talk to someone. It's like, why do you go to a doctor? It's always smart. I know we all think we're smarter than the next person, but there's tried and true things that happen in the markets and not just in the equity markets. And talking to someone like if you ask, I think you would ask a typical financial advisor. I feel like the stereotype would be they'd say, nope, terrible, get out, and it's not the way he looked at it. So, Kirk, I thank you for coming on, and hopefully you'll come on again. Guys, check out the Money Tree podcast, and you can follow him on Twitter at Kirk Chisholm. I'm going to spell it for you if you're listening on Sirius, KirkChisholm on Twitter, and you can get more updates there. And the innovativewealth.com is his website. Thank you, Kirk.
Thanks for having me on the show, Jason.
Yep. Talk to you soon.